All right. Hey, good morning, everyone. Welcome and thank you for taking the time um, to join us live. I really appreciate you dialing in, as always. And I know it's hard when you're so busy and everyone's trying to get in the field and get all your work done. So I value your time, and so I'm going to jump right into it and try to make the most of it for you. We're going to do three things today. First, I'm going to go over real quick on the fundamental overview. And then I want to go back. I want to look at what corn did and how it topped back in 2012. And then I want to spend the bulk of our time looking at corn with a blank slate and kind of building the whole technical picture and talking about the strategy and how we're going to make decisions moving forward, because we're approaching some unprecedented numbers and times. So what are we going to do, right? That's got to be the focus. Now, fundamentally, there's three things, right? And these are all bullish. Um, Number one, and honestly, it's all about supply. Um, we're coming into a point in time where the market has been expecting new supply to to relieve the high prices and to bail out the end users, and they're just not getting it. You know, the supply in the Ukraine is getting smaller, not bigger. And all of the analysts that have been banking on peace and just kind of business as usual are that's slipping away, right? Can it still happen? Can we get a ceasefire and Russia pull out tomorrow and Ukraine deliver a full crop? Maybe, it could happen. Certainly, peace peace breaking out would cause some selling, but today that's not happened, and we can't rely on it to happen. Second, you've got our weather, and right now we're honestly too wet. So what does the corn market have to do in order to break? Well, it's got to buy acres away from beans. And in order to do so, it's got to sway the economics so dramatically that farmers would rather have corn than have $15 new crop beans. And so you've got to take corn much, much higher in order to get that to work. And simply put, we're just not getting those numbers yet. So, um, so the weather forecast is not conducive to that acreage shift that the market wants. Now, third, it's Brazil. It's too dry. It continues to get dryness, and it's just kind of it's really under pressure because that crop is on the verge of getting smaller, not bigger. So fundamentally, nothing's changed on the demand side. We haven't slowed it down at all, and the supply side continues to get tighter when it should be the thing that's providing relief. So you're seeing just this pent up pressure, buying pressure against corn because the farmer doesn't have any old crop left. Somewhere over 80% is where the farmer's sold. So there's very, very little old crop supplies. Their new crop supplies are dwindling quickly. I've been reading anywhere from 50 to 70% of new crop has already been priced. And then third, the end users are pretty much hand to mouth, and they don't have sufficient coverage moving forward. They keep hoping that something's going to bail them out, and it's just not happening for them. So fundamentally, nothing's changed from last week. We're bullish, and we're not slowing demand down like we need to. All right. So let's talk about what corn looked like and what it did in 2012, which is the chart you have in front of you. This is the daily chart in 2012. Now, there's three numbers that I want you to write down and put in the back of your head, okay? It's 819, it is 834, and, I'm sorry, 830 and a half, 819, 830 and a half, and 844 and 3/4. 819 is the highest ever weekly close on the front month corn contract. 830 and 3/4 is the highest ever daily close on the front month corn contract, and 844 or 840, let's look exact here, 843 and 3/4 is the highest ever posted price on the corn contract. Now, what you should see immediately when you get up, when you look at this chart, is that this topping action does not look like a V. It did not V top like so many people say that it did. If you look at the monthly chart or the weekly chart, it looks like it V topped, but it didn't. We consolidated in this $8 range for almost for most of July all the way to September. You had lots of time in order to sell this thing moving forward. Now, what we're going to do here in a minute is I'm going to build the suite of technical indicators that we're going to use to help us predict our tops, okay? And I've got basically all of them put up here on this chart for you, okay? First of all, you guys all know I love the cloud. When you come into the daily cloud, it's a significant deal, and you can see what happened when it came out. That price is 777. So from 844 to 777, that's where we started closing inside that cloud. Second, you look at the technical setup where you had these bottoms right here, and we finally broke below it, came back to test the top of it, and failed. That was a technical setup indicating lower prices. Third, you have this big 13 right here. Now, there's two 13s that you should see on this chart. There's this one right here, and there's this one right here that marked the low in May, that marked the peak, the absolute peak in late August of 2012. So these 13s at these price levels start to become relevant, but they're not. Well, I'll get to that here in a minute. I'll tell you why I don't think they're quite as absolute in this environment. Now, last but not least, what I want to show you are these indicators down here. You guys have been with me a long time. You know I love divergences. So divergence is are the first things that you see when you see a disconnect between higher prices and declining interest among the funds. So here in this type of topping action, look at the divergences that we had during that entire time frame. So we sat here and we banged around all-time highs with just less and less interest for a month and a half. We just continued to score lower lows across MACD, stochastics, force index, RSI, you name the oscillator, it was posting lower lows all the way through. Perfect divergence setup. Now on the weekly chart, we didn't get a divergence. It was just strong, strong, strong. And so it sat there and it lulled people to sleep for a month and a half before it took them off. And if you go back and find, most analysts were looking for higher prices into this time period. And they just simply didn't come. And the reason is because we had a singular supply shock. The weather in South America was good. The weather in Ukraine was good. Their production was ramping up. We were the sole weather problem at this period of time, okay? And the demand strength from ethanol was well known at this time too. So it didn't take much to really break it, and the market held off as long as it could before it started to rally. You know, it really turned hot and dry, and the market really got going. It sat there and paused. Then it realized, and then it decided it could break, and it just lulled everybody to sleep and didn't ever give them the chance when it did finally break. And you have the implosion, right, which is right here. Boom. That did not happen until a year later in July of 13. So farmers had ample time to get protection in place at 650 or higher. I mean, you had a year and a half to get things in order. Now, let's go to the current market, okay? Because we know history is a guide, but it's not an absolute, and it definitely can't be relied upon to just completely repeat itself. And if you want to look at this move in totality from the beginning, it looks nothing like the move in 12. It is much more powerful, and it's much better rooted in fundamentals than the 12 move was. The 12 move was rooted in hot and dry weather in a heat dome over Iowa. That's what got 12 going. What got this one going was Trump's policies, higher, bigger, putting China to the fire, making them pay up for stuff. So demand went through the roof. They had crop failures. And now we've just had successive crop failure after crop failure after crop failure, and the governments just haven't recognized it. But the market hasn't lied to us. So the strength behind that market is so powerful that if I take this back out and you look at the trend that we've looked at, we don't have any of the divergences on our charts today that we had in 2012. So nothing about this move speaks of a VTOP or even at this point a consolidation into all-time high prices. Now I've got the July contract up here, okay, and I have reasons for that. But May, as I speak here, is trading at 808. Now remember, 819 is the highest ever weekly close, right? What are my numbers? 813, 819, 830 and 3/4, or 830 and a half, and 843 and 3/4. So will we hit that this week? I don't know, but that's why we're consolidating right here, because this market has been loath to ration anything, and we've said it for months. It doesn't want to ration unless it absolutely has to, because it's a last event. And so I think you're starting to see funds rethink their thought process since March 31. What has been their thought process? Well, it's been, I'm going to sell the nearby because the USDA says we have plenty of stocks, and I'm going to buy December because it's got to go higher to buy acres. Well, I think that they're starting to unwind that, and they're starting to put the pressure back into the front month, because they're recognizing that we really don't have the stocks that are available to bridge all the way through a crop failure. If our weather, and we're not going to get the acres, and Ukraine's not going to come online, and South America is going to get dry, then there's not enough residual supply July forward to get us to new crop. We have to ration here in the front right now in order to push it. So I think what we're getting ready to see is corn go go higher. I'm not even gonna say how high I think it might go, because I really don't want to get bulled up. What I want to focus on the last 8 minutes is what we're going to look for. Now, what I've got in front of you is an unmarked chart, right? This is just a simple candlestick chart of corn, and you can see from this is March 29th. From here, we're up a little over $1, right? We're now consolidating just a little bit above $8, right? Hey, we broke a significant number. We got to come back down and test it. We got to hold it before we can push higher. Makes sense. This market is behaving very, very orderly and without any panic. I think that that's how this is going to end, is with panic. I think your end users are going to completely panic and have to come and rush to get coverage. I think that the farmer that's already been sold is going to get in trouble, and I think that they're going to have to come in and buy it in order to re-up things. So that's going to put buying pressure on here, and the funds are going to get greedy at the end. And so you got 3 sources of buying pressure that have no choice but to buy higher prices, which is what I think is going to create something that we haven't seen before. So what indicators are we going to look at in order to call a top? Well, the first thing I want to look at is our trend following indicators, okay? So nothing has been more powerful than the Tom DeMark indicators that I started looking at in 2016. In 16, I was introduced to the DeMark indicators, and there's hundreds of them. Tom DeMark was an absolute genius. He's very much still working, but he is an Elliott wave and Fibonacci absolute genius, and his indicators are phenomenal. There's been nothing that has tracked this move in corn from 2020 forward better than this indicator that I have right here. And it's worked on every time frame, and it's worked like in perfect harmony. So this is our main guide. Now, what you should see immediately is a 5. 5 is as high as it goes. There is no 6, there is no 7, there is no 8. So at some point, this 5 is going to reset into an A, a B, and a C. and it's automated. There's no judgment here at all on our part. It's just it will or it won't. And this move has already been extended, but if you look at the shorter term structure, which I don't have time to get into, it's not done yet based off of this move right here. So if we look at this move from a DeMark TD wave indicator, it's got at least one more 5-wave move up sequence before it completes on this particular turn. And so the question is you get a day like yesterday and you say, what's a reasonable allowance for a decrease in value before we should get worried? Well, let's look at the Fibonacci retracements here, okay? So if I snap it and assume that yesterday's high is the high, and we're now into a corrective phase, which will be an A, and then we'd get a B, and then we get a C. If that's a relative deal, you're looking at a move down to 740 to 770, anywhere from 38.2% to 61.8% as a reasonable expectation for a pullback if it were to happen. And you look for this to happen with some different conditions in line. First is we'd want it to stay within parallel lines. So we'd be able to snap a line from here to whatever the next peak is, and then we'd snap it to the intermediate low, and we want this move to stay contained inside that channel. And we'd want to see it overlapping, and we'd want to see it choppy, slop and chop, declining volume with overlapping looks. And then we'd want to see it find support around one of these lines right in here. If we trade down into it and start to look worse, then we'd say, hey, maybe we have an issue. Now, the second indicator that we want to look at is the cloud. Now, I remember the cloud plots. It plots a combination of moving averages on a forward basis, and I want to show you how these are working together here. Okay, so if you take your DeMark indicator and you take a fib retracement and you take it to the bottom line in the forward, look at what we have. You have an entry into the daily cloud at about the 740 level. So it would take a move somewhere down into here before we would even start to look at it being overwhelmingly negative. Now, look back at what we also just did. We would have failed below prior highs, 819, those 819, 834, 843. We would have then failed. We've come back inside our cloud, exceeded the Fibonacci retracement levels that would be that would make sense logically to be a reasonable retracement, and we would have penetrated back into this consolidation zone and given back this move. So this would be chart damage if we came all the way back down and came back down inside this and broke all of these. That would be a significant damage and something that we would want to look to sell. We can also see if we start overlaying our oscillators, and I know I'm getting ready to go a little bit long here, but I want you to stay with me because I'm trying to give you an idea of what we're looking for. And it doesn't matter if we're at 740, 840, 1040, 1240, I don't care what the number is. The setup is going to be the same at any level for what we're looking for to have enough chart damage in order to say, hey, this massive uptrend that began in 2020 is done. Okay? You got to have all of these conditions present before it happens. So let's look at the force index. We're going to see something, we would see continued weakness into this forecasted move. We'd see it break the zero line, and we'd probably see an acceleration to the downside. That's where you'd want to start selling it. Today, the bulls have the ball. There's nothing to worry about on this indicator. It is not giving us a sell signal. Now, let me take that off because I don't want to get the cloud too. Now let's look at stochastics. Stochastics are super strong. If we get that type of movement and we're trading down into here, and these continue just to weaken and weaken and weaken, you might start to get some sort of confirmation from your oscillator that a peak is in place, right? There's no divergence on stochastics. There's no reason to think that we're going lower. RSI, same thing. Extreme bull market right here. This trend is strong. It's intact. There's no weakness. There's no divergence on your RSI. What's going to happen if we break down into here? Same thing. You're going to see it give. You're going to see it give up its bull market support. You're going to see it trade back below 60. This is the line that you want to see it hold if you're going to maintain a bull market, which is 40. That would be bull market support. If we're trading down into the daily cloud below the 61.8% retracement, we get below 40, major chart damage, big weakness, probably need to sell it. Okay, so that's a lot of information that I just pumped at you on what we're looking for in corn, and it's not any one thing, right? It's a combination of all of the knowledge and all of the indicators that we use in order to say, hey, this is enough significance that we need to sell it. And nowhere in the move from 2020 forward have all of those conditions been met. Not one single day have they all been there. So this move has been intact all the way on the daily chart without any weakness. So I promise you that when you call and I say, hey, we're going to sell this thing, but it's not today, I promise you we are watching these things minute by minute and hour by hour, waiting for something to confirm enough weakness to get it going. You know, it could be this week. I don't know. It could be next week. But what I think is happening with the fundamental backdrop of what's what's unfolding here, I think that we're getting very, very close to having to absolutely ration in the front. And I think that's going to send corn parabolic. I don't know how high it goes, but I don't see any other way around it just based on all of the fundamentals. Maybe that's a topping sign. Maybe when guys like me start to get too bullish like that, maybe that's a topping sign, and maybe that means nope, we're overdone. I don't know. But I know what we're trying to focus on is when do we sell it, because we're not going to get left behind it. So I'd rather sell it early and get psyched into it on something significant than wait. But for today, we got to be patient and we got to let it do its thing, because there's nothing that's out there that's decided to break this market. I didn't even talk about beans and wheat. Corn, it's all eyes on corn, guys. Nothing's going lower if corn goes higher. So I would just stay patient, and we'll continue to watch it. All right, remember, there is significant risk in trading futures and options, and you should only do so in light of your own financial condition. I really do value your time and hope it was meaningful. If you have questions, please call, and I'd love to spend time going through more of it with you. Have a great day. We'll talk to you next week.